Hello, I'm Justin Urquhart Stewart, and welcome to a short talk we're giving on one of our new funds. Well, it's not actually new, it's been operating for a year. It's the 7am Unconstrained Fund, and with me is Alex Scott, who's been leading the team running it. Alex, tell me, what's this fund for?
Well, what we wanted to do was to develop a fund that could build off the same structured approach and research that we do for our strategic asset allocation, but apply it in a very different way, taking off some of the constraints that are necessary for risk-rated funds and allowing the managers much greater flexibility in how they apply that research, how they apply that work, where and how and why they're taking risk in the fund. To aim for a different outcome, to aim for a fund that's looking to beat inflation over the medium term.
Now, our industry loves having titles into our time, so that people try and put it into another bracket. It's not, say, a global hedge fund or a macro hedge fund or an absolute return fund or anything like that.
No, I mean, we're always a little bit uncomfortable with the language of absolute return funds. I think people understand that differently in different contexts. And we've always shied away a bit from that language. I think we're very clear about what we think this fund is for and what it's meant to do. It's meant to beat inflation by a margin on a rolling 3-year basis. That's what we're aiming to do. That's the context we have for all the trades, the positions in the funds are considered in against that context.
Explain to me then actually how it works and how it differs from what we're doing already.
Well, in contrast to our risk-rated funds, where we're very much operating within a defined risk band for each of the risk profile funds, what we're looking to develop here, or what we're looking to implement here, is a sliding risk scale. So when we think the environment is attractive, when we think there are opportunities to be well rewarded for taking risk, we can turn the risk dial up in the fund, take more risk, put more aggressive positions into the fund. When we think the environment is more challenging, when we expect much more volatility or much more downside in various asset classes, then we can turn risk right down and be very much more cautious and very much more defensive.
Okay, so much more adjustable. But quite often then taking the same themes you're using in the constrained portfolios, but allowing them, as it were, sort of greater level of range.
Yeah, I think that's absolutely right. I mean, we're building off the same strategic asset allocation work and how we model risk and how we model long-term expected portfolio returns. We're building off the same tactical asset allocation ideas, the investment strategy of how we see the world today. So you'd expect to see similar ideas and similar themes represented in this fund.
So take, for example, last year, I mean, you actually had this issue of with the debt from Spanish and Italian governments, which was appearing a certain amount in the more constrained portfolios, but this was given a greater level of ability to use in the unconstrained one.
Yeah, that's absolutely right. I mean, where we have a really strong idea, where we see good risk-reward trade-off on offer, we can go for those ideas in a much more emphatic way in this fund. We can make much more use of them. We've done it with the Spanish and Italian debt last year and into 2013 as well. We've done it with the Eurostoxx dividend futures. It's been a trade that was very heavily represented in this fund through 2012.
So Alex, who is this actually for?
Well, I think the fund's suitable for investors who are looking for a fund designed to beat inflation over the medium term. We're looking to beat inflation by 2% on a rolling 3-year basis. That, I think, has got quite wide appeal. Potentially, investors will use it as a satellite alongside a core portfolio. They've got to be comfortable with a fund that will take a variable level of risk. We will slide up and down the risk spectrum, but I think that's got quite wide application.
This is a unique point I've seen with this, a different pricing structure. Just talk me through that in a bit more detail.
We think it is unique. I mean, we think it's right for fund managers to be, in this kind of strategy, very, very strongly aligned with investors.
I, as an investor then, I've invested money here, the performance doesn't come through for, say, the first quarter. What happens?
Well, we look at the end of every quarter, we look and compare what the fund price is, what the fund value is to 12 months previously. If the fund has lost money over that 12 months, then we reduce the management fee on the fund. So we share our investors' pain.
Right, so for once we're actually seeing the position that fund managers are actually in a position where they are benefiting or losing according to the value of the fund.
I mean, it's performance related in very meaningful sense. I mean,
very refreshing. Don't often get that in our industry. Right, okay. So what does it actually then offer the individual client? The ability to be able to have this variability, and does it sit alongside then the other portfolios as well?
Well, we think it's widely used, or we think it's got wide appeal as a satellite investment alongside a core risk-rated portfolio. I think investors see that as something where they're building in a part of their portfolio that's very much strongly focused on beating inflation. And that, I think, is an objective that many investors would have.
And how is it done?
We're very pleased with how it's gone so far. I mean, in the first year, the fund's performed well ahead of its expected returns, and done so with volatility that's been at a reasonable level.
Well, thank you for watching. I hope you found that interesting. Really, the whole idea of this is taking our ideas and that we put into our constrained portfolios and giving them a greater range to be able to actually fulfill, hopefully, their potential. But adding what I think is a really quite unique charging structure, which I think is a greater level of sharing of risk and a fairer charging structure. Thanks for watching. Alex, thank you for your time. And may I wish you every luck with your investing for you and your customers. Bye-bye. Thank you.